Welcome to the It Takes a Village podcast by Village Bank, where we bring leaders with expertise in finance, accounting, entrepreneurship, leadership, and branding into our village to help entrepreneurs like you in our community. As an entrepreneur's bank, we hear all the time that you want to know more about the financial nuances of starting and running a business. These questions are profoundly important and can be incredibly stressful. That's why we're inviting prominent leaders and friends of our village to weigh in and build a village of answers and connections on the It Takes a Village podcast. Thank you for joining us. Today we're talking to Scott Schake, Senior Vice President at Central Minnesota Development Company, an SBA loan provider and small business financing expert. We're also joined by our very own villagers who specialize in SBA lending at Village Bank, Tim Walker and Kraig Kliber. If you've been asking questions about whether an SBA loan is right for your business's goals, you'll want to listen as these SBA experts discuss the loan financing options and the benefits of these for small business owners. They'll answer the question, is my business the right fit for an SBA loan?
Since I have all the SBA experts on here today, let's talk. Can you guys set up the framework for us on what an SBA 504 loan is, what an SBA 7A loan is, and maybe talk about what you can use the loans for, the parameters around them, maybe the amortization, maybe what industries or what products they're generally used for, to set up the framework for the different types of SBA lending that preferred lenders like Village Bank are able to utilize for Main Street.
The 504, SBA 504 program, which is what CMDC does primarily, is a fixed asset financing program for fixed assets, land, building, and significant pieces of equipment. It doesn't finance working capital or business acquisitions, things like that. That's where the 7A programs would come in. It does not replace bank financing. It's a partnership together with the bank lender. I get that questions all the time from the customer. I already have a bank. Why would I want to work with you? We're not in competition with Village Bank or any other bank. We're a partner with the bank in order to obtain that favorable financing structure for the borrower. So just a clarification.
7A loans can be used for fixed asset financing as well, real estate and equipment, but then everything that he excluded, 7A lending is available for. So we can leverage it for business acquisitions, working capital, just about anything that you can think of on the business side of the bank, we can leverage the SBA 7A loan program for. It's considered a guaranteed loan program, which just means that Village Bank is the sole lender in the process. In general, our turnaround time on SBA 7A financing shouldn't be much different than our regular turnaround time for conventional financing.
What does being an SBA Preferred Lender mean to a business owner looking for SBA funding?
What that really means is that as a financial institution, we approve our own 7A loans. And obviously that helps us speed up our process in getting 7A monies out to our customers.
What are the benefits of the different SBA loan options for small businesses?
Kind of the three advantages of why you'd want to use it, or how it would benefit the borrower, is it's going to provide higher leverage than a commercial loan would, up to 90% of the project cost or the appraisal, whichever is the lesser of. So, for example, if you're going to be buying a $1 million building, Village Bank would provide a first mortgage, senior lien mortgage of 50% of that $1 million or $500,000. And then CMDC through the SBA program, the 504 program, would provide up to 40% of the $1 million or $400,000 in a second lien position. The borrower then is only because it obviously 10% is still a significant number, but the borrower would need to come in with just 10% equity as opposed to maybe 20 or 30% equity in a conventional loan situation. So it preserves cash flow, or preserves liquidity, I should say, for the client. It helps them to keep that extra, what they would have had to put down on the building, to keep that in the working capital account to fund the business growth, hopefully. The other advantage for the borrower is it provides them a long-term fixed interest rate up to anywhere. There are three options. One is a 10-year, one is a 20-year, and relatively new is a 25-year option, which was introduced a little over a year ago and has become by far the preference for most customers. That rate is fixed for the entire term of the loan. There's no balloons, there's no repricing. Once the rate is set at loan funding, the customer does not need to worry about rate increases for the life of the loan. And then the other advantage is the interest rate right now are typically is below market. And when I say market, there generally isn't a market for a 25-year fixed rate commercial loan. So your customer is able to lock in let's say they chose the 25-year option, they're able to get a 25-year fixed interest rate somewhere in the mid to high 2% range right now. That's at an all-time historical low. We haven't, in my how many ever years of doing this, 30, I guess, 30 plus, we've never seen anything like that before. So obviously now is a great time if your customer has a need for fixed asset financing, land, building, or equipment. Now is a great time to talk to us and for us to work together with you guys to put together that long-term financing at extremely attractive rates.
The advantages to 7A lending are similar. There's three things that we look at when 7A lending. One of them being, in most cases, the equity contribution in a transaction or a project would be less than what we would expect in a conventional scenario, as low as, say, 10% versus 20-25% on the conventional side. In some cases, in fact, we can do 100% financing on equipment if we have an existing relationship with that customer and we can leverage some of their other equipment. Also, longer amortization, as I mentioned. In most cases with a 7A loan, we can go out longer than conventional financing, which helps with cash flow, obviously. And then also, from a collateral perspective, with the SBA guarantee, we will look at situations where we are either under collateralized or we have collateral that maybe we wouldn't typically leverage in a conventional loan structure. So lots of different advantages to the 7A program.
What do the qualifications for those different types of loans look like?
The requirements or guidelines from a business perspective is it needs to be a profit business. Average annual revenue for the aggregate or preceding 2 years is net income is $5 million or less, and then $15 million from a tangible asset perspective.
The 504 program is the same as that. The first test is it a for-profit business? It has to be a for-profit business. We're not able to, 504 or 7A isn't able to finance nonprofits. And then, as Craig mentioned, the size standards are a net income of 2-year running average net income after tax of $5 million or less and a tangible net worth of $15 million. That opens up, in my years of doing this, I think I could probably count, well, I know I can count on one hand, maybe count on 2 fingers the number of times that we've had a business that we couldn't fit within the size standards. There's alternative size. If you don't meet those 2 size standards, there's some alternative standards that you can also use based on number of employees and industry type and things like that. So usually the types of clients that we will be talking to and working with will fit within those size standards.
On the real estate side of things, is that it needs to be owner-occupied real estate. We cannot do any financing from the SBA perspective for any investment type real estate.
If a business fits all of those standards, those qualifications, and they also feel the benefits of an SBA loan align for what their goals are, what would they want to do once they have the information? What would they want to do next?
Hopefully on the front end, they're reaching out to their banker just to discuss the project or the perceived project so they can determine what options may be available. They may not be familiar with an SBA lending platform in general, so having some information and being able to gain some general knowledge on the different uses and what may be applicable for their specific situation is important. Determining what the future may hold for that business and what makes the most sense based upon what their intentions are and what their projections look like, and the knowns as well as the unknowns.
From a kind of collecting financial information and that sort of thing, it really is not too different than what we would do from a conventional standpoint. Really, we're kind of looking for 3 years of tax returns, 3 years of annual financial statements, personal financial statements to guarantors, personal tax returns for guarantors, and depending on the situation, we may, look to some projections if available and that sort of thing. But really, that would be the conversation we had with the banker up front, and if deemed that it may make sense for look towards the 504 program, well, then that's when we would contact Scott and make sure that the customer gets introduced to Scott, and we have maybe a joint call to discuss the project, next steps, and that sort of thing.
If the customer has determined that 504 is an attractive option, or if they've met with the banker and you guys believe that makes sense, it's really important to involve us early on, the CDC, the 504 lender, because there are some ways that things can go off track. I think Craig mentioned or alluded to earlier about occupancy is one of the eligibility requirements. What we explain frequently is, and we've got a situation exactly that right now. The credit is fine, but the eligibility boxes we can't quite all check. So it's important to go through the eligibility first, even if it appears to be a good credit. For occupancy, for example, all SBA loans, as Craig mentioned, all SBA loans finance owner-occupied real estate. There's a definition of what that is. If it's an existing building, the person who's buying it has to occupy at least 51% of it. So there is some provision for a rental piece in it, but we have to know that up front, and it has to fit that box. Size, we talked about size standards a little bit earlier. That's another one that we want to cover on the front end. Personal character issues oftentimes or sometimes have to be dealt with. If there's a criminal event in the borrower's background, we have to dig into that and document that does not disqualify them. The last thing we want to do is to have one of the bankers tell the borrower that they're going to get them 25-year fixed rate, financing at 2.5%, whatever the terms are. And then we get to the end of the deal and we get involved and say, no, sorry, it doesn't qualify or it's not eligible. That's not good for anyone. So the sooner that CMDC gets involved in the transaction, the better. It's important to have a bank partner in the transaction that understands and knows what they're doing. In this case, obviously Village Bank. We enjoy working with Tim and Craig and the crew at Village because you guys know you understand what's happening and how to guide the customer through the potential issues that may arise.
What are some other typical indicators for business owners who might not be a manufacturing company who need equipment, but maybe a startup business? What is an indicator for those types of businesses that an SBA would be a smart option?
Well, the reality is it should be looked at by any startup, unless there's a high amount of equity or cash into a transaction. There's not many banks out there that would be willing to provide financing to a startup business. So that's one of the reasons why the SBA 7A platform exists at this point in time, frankly.
And another very popular use of the 7A program is for business acquisitions and for partner buyouts. In general, business acquisitions and or partner buyouts, there's going to be a collateral shortfall. So like what Craig had mentioned with startups, with that 7A program, we can have some comfort with the SBA guarantee to be collateral deficient. And based on what's going on out there right now with a lot of boomers and old folks now looking to sell their business and retire, there's a lot of opportunity to leverage the 7A program to do some business acquisition financing.
Specifically regarding startup financing, the 504 program, well, it can be used, and we've done startups, but 504 is more useful for maybe second stage or expanding companies who need more room or more equipment. I hearken back to a mentor of mine when I was on the bank side of things years ago. The owner of the bank used to tell us, we were a major SBA lender, 7A and 504. He used to tell us that specifically in the 7A world, that we were not bankers, we were dream makers. And I think that sort of sums up how the 7A fits into this. The 7A program allows Tim and Craig and the rest of the folks at Village Bank to make dreams happen for folks that maybe are a little light on collateral or a little light on equity, or it is a startup that's harder to finance. They don't have a background in cash flow history. You're able to step in with a 7A product and make that dream come true, help that person get into business and hopefully they succeed and have a long history. And then who knows, maybe 5 years later, they're ready to buy a building. And that's when Scott and CMDC steps in to help them expand to the next level. So I always took that with me. The dream maker comment I thought was very appropriate. Summed up what the SBA allows banks to do.
Thanks for joining us on It Takes a Village, hosted by Alicia Webb. If you liked what you heard today and want to hear more, follow us on social media at Village Bank Online on Facebook and Instagram, and Village Banking on Twitter.